Welcome to Personal Finance for Long-Term Investors, where we believe Benjamin Franklin's advice that an investment in knowledge pays the best interest, both in finances and in your life. Every episode teaches you personal finance and long-term investing in simple terms. Now, here's your host, Jesse Kramer.
Hello and welcome to episode 111 of Personal Finance for Long-Term Investors. My name is Jesse Kramer. By day, I work for a fiduciary wealth management firm helping clients all over the country. For more details, go to bestinterest.blog/work. A link is in the show notes. And by night, I write a blog called The Best Interest, and I podcast here on Personal Finance for Long-Term Investors. I help busy professionals and retirees avoid costly mistakes and grow their wealth, and I do so by simplifying complex ideas about personal finance, from investing to taxes to retirement and beyond. And this is an interesting, slightly out-of-order bonus episode meant to serve as a companion episode, if you will. And now a companion to what? The same day that this episode is published, episode 555 of ChooseFI is being published, featuring just a really interesting conversation between Brad Barrett, the host of ChooseFI, and myself. I really recommend that if you haven't listened to that, if you're hearing my episode here first, that you go over and listen to episode 555 of ChooseFI. Brad and I, we talk about the pitfalls that occur when people, whether it's people in the FI movement, just DIY financial planners in general, do-it-yourselfers, when they attempt to over-optimize their financial plans. And to put it simply, to put it bluntly, we only get so many optimization points, if you will, that we get to use in our financial plan or just in our lives in general. And in your plan, if you want to say optimize for simplicity, well, then you probably can't also tax loss harvest and create a Roth conversion ladder. Those aren't quite simple enough. If you want to optimize for being able to sleep well at night, well, then you probably won't be able to own 100% stocks. Not that you'd necessarily want to always in the first place. And the idea is if you're going to optimize for sleep, you're probably going to have to sacrifice some long-term returns. And then there are two of my favorite financial planning metaphors, the puzzle pieces and the spider web metaphors. If you try to solve a puzzle without all the pieces, you're going to fail. And if you try to optimize your financial plan without understanding all of your unique pieces, you'll also fail. And like a spider web, sometimes the intricate kind of interconnectedness of a financial plan can surprise us. We tug on one thing over here, hoping to optimize it, but we end up pulling apart or weakening the web over there unexpectedly. So that's the idea of the ChooseFI episode, and we do dive into some specific examples of planning gone wrong, I suppose. But just in general, we spend a good amount of time, maybe more on the philosophical side of why it's important to, yes, we want to optimize, we want to improve, we want our financial plans to be hardy and foolproof, we want them to be sustainable, we want them to provide us with good returns, but over-optimizing, this is something I've talked about here a few times before, just that over-optimizing can lead to problems. So make sure you go over to ChooseFI, check out episode 555, and if you happen to be listening right now coming from ChooseFI, well, welcome. I think you'll find that this podcast, Personal Finance for Long-Term Investors, I think you'll find it to be an excellent way to add detailed and nuanced financial planning ideas into your personal quiver. So give this episode a listen to a few more episodes if you'd like. The AMA episodes, I'll say, are probably my most popular episodes, so you can go back and listen to my Ask Me Anything AMA episodes. And if you like it, hit that subscribe button. So before the meat of this bonus episode, we always do a quick review of the week, and this one comes from Skip from Omaha. Omaha, the home of Warren Buffett. Go back to episode 110. We talked all about Warren Buffett. Skip says, I love the detail. I started listening a few months ago after hearing Jesse on Stacking Benjamins. Jesse's style is wonderful, an amazingly detailed and informative discussion on a level that's just right. With his thoughts on topics that appear again and again in personal finance, Jesse often touches on angles and nuance that I had not previously considered. I'm quickly becoming a regular listener. Well, Skip, thank you so much for the kind words. Shoot me an email, and I'll send you a super soft podcast t-shirt as a thank you for that wonderful rating and review. So with that, let's begin the companion content to ChooseFI episode 555. One thing that Brad and I talk about in that episode, we have a little sidebar, maybe 5 or so minutes. We talk about this thing called the middle class trap. Now, some of you listening, especially if you're maybe a diehard on the ChooseFI Facebook page, or if you've just been listening to a lot of financial podcasts recently, you'll know exactly what the middle class trap is. But for those of you who have never heard of that word before, or that term, the middle class trap, it refers to the situation where someone is on the borderline of financial independence, if you look at their net worth, but that a lot of their net worth is quote unquote trapped inside of real estate, home equity, or it's trapped inside qualified retirement accounts, 401ks, IRAs, things that they can't touch until they're 59. So if you just look at that one number alone, just one number on paper, net worth, you might look at a person and say, oh, they're probably financially independent. I mean, look at how much money they have. But in reality, this person feels a little bit trapped by the nature of their worth, in that they can't really tap into their home equity in order to retire and live off that as an income stream. And they're worried they can't really tap into their retirement accounts before age 59, lest they suffer some sort of penalty or tax or whatever it may be. So anyway, that's the middle class trap. And there's an interesting episode of the Bigger Pockets Money podcast. It was episode 651, published on June 20th. Where Mindy and Scott, the hosts of Bigger Pockets, they had Brad Barrett of ChooseFI go onto their podcast, and they had a pretty lively debate about the middle class trap. Then Brad and I discussed it together on ChooseFI, and then that brings me here to today. So I guess one part of the conversation is, how exactly do we define financial independence? Do we look at someone's net worth? Do we only look at someone's investable assets? What about a primary home? And my 2 cents is, well, it's not quite either. At least that's not the way I think about financial independence. Instead, the way I think about it is, we need cash inflows in your life to offset cash outflows forever, right? Throughout retirement in a healthy way. And so if an investment portfolio is the only source of those cash inflows, then yes, it's appropriate to use a safe withdrawal rate like the 4% rule. And okay, that is up for debate, the 4% rule. Maybe it's 4.5 or 4.7 or 5.0. That's fine. Maybe we're uber conservative and we think our safe withdrawal rate is only 3.3% or something like that. A little bit of a personal choice there. I certainly have my thoughts, and we can dive into that on a different podcast episode. So we take our safe withdrawal rate, we understand what our annual spending is, we take the inverse of our safe withdrawal rate. So for the 4% rule, the inverse of that would be 25, right? 100% divided by 4% is 25. So we take our annual spending, we multiply it by 25, and that needs to be the size of your investment portfolio. That's your FI number, as you will. So it's not net worth, it's the size of an investment portfolio. But if you have rental income, which is a big part of the Bigger Pockets philosophy, right, is owning real estate rental income. If you have rental income, if you have other passive income, eventually you'll have Social Security. You're retiring early right now. Maybe you don't have Social Security right now, but eventually you will. Well, all of that stuff is going to reduce your cash inflow requirements. It's going to mean that you don't need to have as big a portfolio as you otherwise would, because you have these other sources of cash inflow that don't need to be coming from your portfolio. And thus, that should fundamentally reduce the amount of investable assets that you need to retire. And one other important side note here, whether it's Social Security or rental income or the sale of a property or whatever it may be, both your inflows and your outflows in retirement, just like in the rest of life, they're going to be lumpy. They're going to ebb and flow over time. They're going to change over time. The 4% rule assumes a constant withdrawal every year, adjusting for inflation. And we know that's just not how the world works. I saw a metaphor recently. Someone said it's like flying a plane, and when you get the pilot to the cruising altitude, you handcuff the pilot's hands to the wheel, and you say, you can't change from here. And it's like, well, I guess on cruising altitude, I don't even know if that's a great metaphor, because cruising altitude implies that we're doing the same thing for the rest of the flight until we land. And even then, like, retirement is just much more volatile than that. The way that someone's spending can change year over year. I mean, I've seen it firsthand at work. People's spending can change by quite a bit, by full percentage points or more on an annual basis, by 5 or 6 figures on an annual basis. So if you're interested, I wrote a white paper that you can download for free. It's at the homepage of bestinterest.blog. And I get into some details there just about this. The white paper is all about building your retirement paycheck. And I think that's a really helpful frame of mind to approach safe withdrawal rates and certain percentage rules and what it really means to be FI. At the end of the day, we have to understand that whether we're retiring in total from a full-time job, whether we have side income, whether we have a pension or Social Security, or whatever it may be, we have to think about the fact that we're replacing income somehow. And all these different pieces, maybe some of it is coming from an investment portfolio, all these different pieces are going to cobble themselves together to provide us with a retirement paycheck. And yes, that retirement paycheck can and needs to change over time. But anyway, this white paper is all about, I think, a good framework of how to think about and build your own retirement paycheck. Anyway, back to the middle class trap. Another part of the middle class trap is this idea that, I can't touch my IRAs early. I can't touch my 401k before I'm 59 and a half, those kind of things. But if you've spent enough time around the DIYer circle, maybe you haven't, I'm here to tell you that there are some really good ways to access your retirement accounts, your qualified accounts, before you turn age 59 and a half. And I'm going to go over 3 of them right now. The first one is called the Rule of 72T. It's also called Substantially Equal Periodic Payments, SEPP, SEP. It's a special IRS provision that allows early withdrawals, a good thing, right? Early withdrawals from a retirement account like an IRA before age 59 and a half and without the usual 10% penalty. Sounds great. Now, to qualify, you must take equal payments. Again, it was substantially equal periodic payments. So you have to sign yourself up for equal payments. There's a few different ways, 3 different ways, in fact, that the IRS approves to find your equal payments. I won't get into those details right now, but there are 3 different calculations, if you will, to determine your equal payments that you get to withdraw from your retirement accounts. And you need to do so for one of 2 options, whichever one is longer, for at least 5 years or until age 59 and a half. Okay, so if you're 45 years old right now and you're listening to this, you could set up substantially equal periodic payments. You're 45 years old. You need to continue those until you're 59 and a half. So you're signing yourself up for 14 and a half years, ostensibly, of equal periodic payments coming from your accounts. It's designed for people who need early access to retirement funds, used quite often by people in the FIRE movement, early retirees. But the thing to be careful of is once you get started, it's rigid. If you modify or you stop payments early, the IRS will retroactively, yes, retroactively apply the 10% early withdrawal penalty to all your prior withdrawals, plus they will charge you interest. Okay, so you don't want to mess this up. You want to get it right. It is a useful tool, but it's got some sharp edges to it. A SEP plan should be designed pretty carefully. Ideally, you'd want to work with a CFP just to make sure that you get all the nuts and bolts and details correct. And the last thing I'll say on the SEP is just for reference, because some of you might be curious. Depending on the calculation method you use, there are 3 of them. One's called the RMD, Required Minimum Distribution Method. One's called fixed amortization, and the other one is fixed annuitization. And you can look those up, or we can talk about them on another episode. But depending on which one you use, and a little bit depending on the length of time that your SEP will be going for, it has to go for at least 5 years. It might go longer if you're younger than age 54. You can expect that something like 3 to 6% of your account balance will be available to you on an annual basis. So again, just for reference, somewhere in that 3 to 6% range is a good estimate. Next, I want to talk about the Rule of 55. The Rule of 55 allows you to withdraw money penalty-free, excellent, from your 401k or 403b. Notice, I didn't say from your IRAs. From your 401k or your 403b, if you leave your job in or after the year you turn 55, or for certain public safety workers, it's actually age 50, but we're going to go with age 55 for now, just for simplicity's sake. So it applies only, this rule applies only to the retirement plan at the job you just left. This rule does not apply to old 401ks. This rule does not apply to old IRAs or existing IRAs unless you choose to roll those old plans or those old accounts into your current retirement account first. In other words, any money that this Rule of 55 applies to has to exist inside your current employer 401k or 403b. Then you are allowed to take penalty-free withdrawals from that 401k or 403b before your age 59 and a half, as long as you're in or after the year you turn 55. So it really, all it does is, right, it moves up that 59 and a half year old age to age 55. It's that simple. The withdrawals are still taxed as income, as they would have been anyway if you waited till age 59. You just avoid the 10% penalty. So again, this rule is designed to help people who retire early or are laid off. They need access to their retirement funds without getting penalized. You don't need to set up any sort of fixed payment schedule like you do with a 72T or substantially equal periodic payments. You just get to take what you need whenever you need it with the Rule of 55. And again, the important catch is this only works with employer-sponsored plans, not with IRAs. So if you roll your 401k into an IRA right after leaving your job, you lose the ability to execute the Rule of 55. So use carefully, again, as long as you have your ducks in a row. It's a flexible way, a great way to tap into retirement savings a few years early without Uncle Sam slapping your wrist. The last one I want to talk about really quick, the Roth conversion ladder. This might be out of the 3 Rule of 55 or 72T, this might be the one that people are most familiar with, but still, it's not an everyday topic that people talk about. The Roth conversion ladder is a strategy to access our retirement funds, again, before age 59 and a half, without penalties, excellent. And it's done so by slowly converting a traditional IRA or a traditional 401k funds into a Roth IRA over time. So how it works. each year you convert a chunk of your pre-tax retirement money into a Roth IRA. So each year you're doing a Roth conversion. That conversion is taxed as income the year you do it. We know that. But then after 5 years, there's this 5-year rule that we've talked about here on the podcast before. After 5 years, you can withdraw the converted amount penalty and tax-free, even if you're under age 59 and a half. So by repeating this annually, each year you're just thinking 5 years ahead, you essentially create this quote unquote ladder. Each year's conversion becomes available 5 years later. And this method helps tons of early retirees bridge the gap, as it were, between their retirement age and then age 59 and a half, when their traditional withdrawals would be penalty-free anyway. But 2 key rules apply here, and we want to make sure we get them right. So each conversion starts its own unique 5-year clock. We need to be aware of that fact. And then the earnings on conversions, the earnings cannot be withdrawn tax-free until you're 59 and a half, and you need to have had your Roth IRA for at least 5 years. So again, the converted amount, the amount of capital, the amount of principal that we convert in the Roth conversion, that is available penalty and tax-free after 5 years. But any earnings that we earn on those conversions in the intervening 5 years, the earnings cannot be withdrawn until we're 59 and a half. So a lot of nuance there and a lot of things we need to make sure we get right. A Roth conversion ladder allows early access, as we said, in a tax-efficient and in a penalty-free way. But yes, it requires planning ahead. It requires keeping good records to work well. Going back to the idea of simplicity, things like a Roth conversion ladder, things like the rule of 72T, not necessarily simple. You know, if you want to use them in order to optimize your retirement plan, by all means, do so. I think it's a great thing to do. But just realize that, yeah, you're taking on some complexity into your life. That's okay, especially if it means you get to save some money along the way. Now, back to the middle class trap. Mindy and Scott from Bigger Pockets and Brad from ChooseFI, they also discussed their reluctance, and I should be specific here. Mainly Scott discussed his reluctance to sell stocks and really to sell any assets in retirement in order to fund his lifestyle. And Brad pushed back on that pretty hard in episode 555 of ChooseFI. Brad and I kind of like both threw up our hands and like, what is going on? How can you not plan to sell stocks in order to fund your retirement? And I want to kind of maybe talk about both sides of this question here. My own opinions first, but then also I'm happy to play devil's advocate a little bit. You know, when I think about my clients in retirement, I mean, they're absolutely selling their assets to fund their retirement lifestyle. Like, of course they are. To some extent, just why wouldn't they be? Why would you save and invest for decades to retire on time or to retire early or to retire to this wonderful retirement life, but then not sell stocks to help that cause? You know, we talk here, I share with you guys, there are 2 drivers to stock returns. There's the dividends and then there's capital appreciation. And to intentionally never sell your stocks, you're cutting off one of those major payoffs. You're cutting off the bigger one, in fact. I mean, capital appreciation is traditionally much bigger than dividend payouts. It just doesn't make sense to me, at least, to plan to hold on to your stocks forever. And I should pause, and maybe here's where the devil's advocate portion comes in, because yes, it's hard to turn from a saver to a spender. We know that. Like, psychologically speaking, if you've been saving for 40 years and all of a sudden you have to start spending what you've been saving, that's hard to do. You hear apocryphal stories, you hear anecdotes, you see studies, and it's common for retirees to have a hard time to switch from saver to spender. And I suppose that means that if you're not spending much, if you're feeling that reluctance to spend, you might not feel the need to sell any of your stocks to support your lifestyle. Like, why? I'm not spending any money. Why would I sell my stocks? But to me, though, that's not a connection to owning stocks per se. Instead, it's just a reluctance to spend money. I mean, maybe we're talking about the same thing, but to me, and I encourage for you to consider that money is fungible. That's a big takeaway. Money is fungible. A dollar is a dollar is a dollar. So if you're comfortable spending $10,000 a month from your bank account, via the income that you receive from your 9-to-5 job, you should feel equally comfortable spending money that comes in via Social Security. You should feel equally comfortable spending money that comes from the sale of stocks. You should feel equally comfortable spending money, whether it comes from a Roth account, a traditional account, a taxable account, right? Money is fungible. And yes, of course, there are tax considerations. Roth, traditional, taxable account. I'm not saying to ignore the tax considerations. There are portfolio allocation questions, and I'm not saying to ignore those. That's the kind of stuff we dive into here all the time. It's important stuff. But once we've talked about those planning topics, and once we've designed some sort of optimization into our financial plan, there's no reason why $100 coming from stocks is more or less valuable than $100 in cash, more or less precious than $100 in cash. It's all fungible, right? You could take that cash in your bank and literally buy stocks with it today. You could convert that money from one asset type to the other type with a snap of your fingers. It's the same thing. It's fungible. And this is the equivalent of saying that ice is better than water or vice versa. Right? It's the same thing. It's just at a slightly different energy state. $100 in cash is the same as $100 in stocks, just at a different energy state. Now, if you have the psychological crutch that's preventing you from parting ways with a particular stock or fund because you've held it for a long time, well, I understand it, but it's just one of the many mental money problems that exists. And we all know of these mental sticking points that can cause major damage to a financial plan. It could be timing the market. It could be habitual spending. Yes, it could be an emotional affinity for holding on to a certain specific asset, even when it doesn't make sense to do so. It's just another reason to consider seeking neutral third-party outside opinions to help you make sure that you're truly making the right decisions, optimizing your long-term financial plan. Here's a quick ad, and then we'll get back to the show. Did you know my written blog, The Best Interest, was nominated for 2022 Personal Finance Blog of the Year, and it's been highlighted in the Wall Street Journal, Yahoo Finance, and on CNBC? I love writing, especially when that writing is to share financial education, and I usually write 1 or 2 articles per week. You can read them all at bestinterest.blog. Again, the web address is bestinterest.blog. Check it out. Okay, now I want to pivot into the second big topic that Brad and I discuss on ChooseFI episode 555. I want to dive into some of the specific areas of over-optimization that I see in do-it-yourself and financial independence circles. So if you've already listened to episode 555, some of what I'm about to say will be a little bit of a repeat, but we didn't necessarily get into all the detail that I have prepped. So I'm just going to share with you some of my prep. If you have any questions, you can reach out to me at jesse@bestinterest.blog. So first, tax loss harvesting. Brad and I did get into this one a little bit. Tax loss harvesting is the, strategic practice where investors sell assets at a capital loss to offset other capital gains. It minimizes their overall tax burden at the end of the year and is commonly employed to try to optimize investment portfolios and enhance after-tax returns. But tax loss harvesting has its limitations, and I think done well and done usually sparingly, it can certainly be additive, but if it's done too much, if it's quote unquote over-optimized, that might be the wrong word, just overdone, usually the last few squeezes, nothing comes out. There's no juice. In the ChooseFI episode, we talked about the wash sale rule, but I'll share it with you here again. There's a big limitation in tax loss harvesting that it's just a tripwire, maybe more so than a limitation. When you sell an asset at a loss, there's a 30-day look back and a 30-day look forward that bookends the sale of that asset. If during that 61-day period, right, 30 days backward, 30 days forward, plus the day of the sale itself, if during those 61 days you bought a substantially identical asset in any account and in any of your spouse's accounts, assuming you filed jointly with your spouse, then your capital loss doesn't count. It's considered a wash sale. And the wash sale rule prevents, manipulating a stock portfolio to accelerate the recognition of tax losses or defer the recognition of tax gains. So there's a reason why the wash sale rule is in there. But again, it's a tripwire. And something Brad and I talked about is, even if 25 days ago in a totally different account, a retirement account, let's say you had a substantially equivalent asset. Maybe it was a very similar index fund. They're both total market index funds or both S&P 500 index funds or something like that. And if 25 days ago in a totally different account, that fund had a dividend automatically reinvested to buy a minuscule share of whatever it was, well, that's within the 30-day look-back period. It is a substantially equivalent asset, and therefore you probably aren't even aware of it. But that fact that trade happened 25 days ago nullifies the tax loss that you're trying to realize today. So just something to be careful there. Now, there are some times when tax loss harvesting is definitely worth it. It's worth it to offset a liquidation event. It's worth it to offset income, usually. It's definitely worth it to offset diversifying from an over-concentration in your portfolio. If you're a equity employee and you've got $1 million tied up in Amazon RSUs and options because that's where you work, well, you want to diversify from that over-concentration anyway. So you might as well use some losses in your portfolio to offset any gains from diversifying out of Amazon. if you inherited a cabin in the woods from your grandpa when he died and you just want to sell it anyway, but maybe it's worth something, it's worth more than the basis you inherited it at, and you'd owe capital gains on that. Well, guess what? You're going to sell the house anyway as part of your overall financial plan. You might as well offset those gains using some losses. So this is where tax loss harvesting can be helpful. Offsetting income is a great one because income tax brackets, at least as of now, income tax brackets are much higher than capital gains brackets. So if you can use a capital loss to offset income, that's a wonderful thing. The one reminder on that front, though, is there's a really specific order of operations when it comes to how losses can offset gains. Short-term losses, first, they have to offset short-term gains, and long-term losses have to offset long-term gains. So you think of it as a short bucket and a long bucket. Then if you still have net losses in either bucket, they can offset the net gains from the other bucket. So in other words, no matter what, capital losses will always offset capital gains first. Short to short, long to long, and then if there needs to be a crossover, there's a crossover. Then, if you still have remaining capital losses, then you can offset up to $3,000 in income, which is a great thing, but only $3,000 per year. But then if you still have capital losses remaining, they carry forward to the next year. The problem, as I see it, though, is that most of the time people use tax loss harvesting in what I would consider a neutral to bad way. And what they do is they simply want to zero out the gains inside of their portfolio. The most common reason I see people using it, they have unrealized losses on their books and they just feel this need to use them. So they think they might as well realize gains inside their portfolio, use their losses to negate the gains and therefore negate some sort of taxes that they might owe this year. And then they reinvest all the proceeds from these sales. At best, this is a neutral use of tax loss harvesting, and it's just a little bit of a waste of time, and the math explains why. So first, by reinvesting all the proceeds of their transactions, and by looking for not substantially identical, but close to equivalent investment types. The famous example you hear is someone will say, well, I sold my S&P 500 index fund at a loss, and I bought a total market index fund as a replacement, because a total market index fund is something like 80% the same as an S&P 500 index fund. So they're not identical, but they're really close. And that's the way that people often approach tax loss harvesting. And so I hope you'll agree with me when I say that the overall portfolio construction isn't changing. There's no fundamental investing benefit, right? It's not like we're diversifying away from a concentrated stock position. It's not like we're selling grandpa's old cabin in the woods. All we're doing is kind of trading one ticker symbol for another, and those two underlying securities are really close to being functionally the same. There's no sort of factor of, well, I ought to be doing this anyway to clean up my portfolio, like in the early example. All we're doing is selling one similar asset for buying another similar asset, and then hoping that the losses and the gains offset each other in some beneficial way. But then we have to ask, well, is there truly a tax benefit? And this is where the rubber meets the road. We'll see if I can explain this well. I would argue that there's no net tax benefit because the dollars that we sell that realize capital gains and then get reinvested, those dollars have an increase in cost basis. We're selling an asset to realize capital gains, and then we're buying some other asset over here. So on those dollars involved in that transaction, they just got an increase in cost basis. While the assets with losses, they get a decrease in cost basis in equal magnitude, right? That the assets with losses, we bought them at $100 per share. So now we sell them, we realize a loss, and we buy back at $80 a share. So that's a decrease in cost basis. The fact that those two changes in cost basis zero out to each other, that's why the losses negate the gains, the zeroing out, and it leads to a zero overall net change in the cost basis of the portfolio. And that means that any capital gains that you quote unquote saved this year, any taxes that you saved this year, you're simply kicking the can down the road to a future year. So now, if you think that you'll pay a lower tax rate in that future year, I follow what you're saying. And yeah, technically that is worthwhile. That's a reasonable use of tax loss harvesting. It's the tax arbitrage benefit that we've discussed here on the podcast many times before. But in most of the real life examples that I've encountered, there's no real tax arbitrage going on. It's just postponing the inevitable tax bill for no real net benefit. Now, postponing that inevitable tax bill, it might be a good thing in a couple cases. I mean, the question should come up, would you rather pay $1,000 in capital gains taxes today or kick that can down the road and pay $1,000 in 10 years? The answer is pretty easy. I'd rather pay that in 10 years. And the benefit of tax loss harvesting in this way, right? This neutral benefit of tax loss harvesting is simply tax deferral. It's kicking the can down the road. I mean, technically it's good, right? The time value of money suggests I would rather pay that tax bill in 10 years, but the juice is only worth the squeeze at large dollar amounts for long periods of time. If you can defer $100,000 in capital gains taxes for 10 years, yeah, go ahead and use tax loss harvesting. But if you're deferring like $500 for a year, the juice just isn't worth the squeeze. Here are a couple other scenarios. Again, this is for, I suppose this is an advanced planning technique, but it's just something to be aware of because there's some other downsides too. One that comes up, maybe not too often, but more often if you're from the FI community. And so if you're coming over here from ChooseFI, this might apply to you. Well, first off, we already talked about a little bit of this. If you want to use your capital losses to offset regular taxable income, you can only do that if you've already offset all of your capital gains. And now what happens if you've done your diligent FI retirement planning and you've intentionally put yourself in the 0% capital gains tax bracket? If you've done that, if you've put yourself in the 0% capital gains tax bracket, you want to realize capital gains and then you want to quote unquote pay 0% tax. Like you want those gains to show up on your tax return and you want them to sit there and be part of the 0% tax bracket. But if you have capital losses, even if you don't want them to, those capital losses will negate your gains. And the gains that you would have paid 0% on anyway kind of just get wiped clean by the losses and you pay 0% on them. So your losses, what did they do for you? They took something that you would have paid $0 of tax on anyway, and it turned it into something that you pay $0 of tax on. Your losses weren't actually used for any real benefit, but those losses are used up. They disappear. You don't actually get to save money with your capital losses. So again, without careful tax planning, your losses might be wasted. And it's just one of those areas of financial planning where I see people sometimes over-optimize to their own detriment. Another detail, death ends the conversation. If a taxpayer dies with unused tax losses, their opportunity to use those losses will disappear forever. So a question of mortality, a question of health, a question of age should be thoughtfully considered as part of a long-term tax plan. Tax loss harvesting, just like all tax planning tactics, should never be considered in a vacuum alone, right? There are simply too many complicating factors involved, too many puzzle pieces. The spider web is too intertwined. It's a tool. Tax loss harvesting is a tool. And like all tools, it can be used as part of a healthy long-term tax plan, but it's certainly not the only thing to consider. Next, I want to talk about asset location. And again, we talked about in episode 555, asset location can be a pretty powerful arrow in your financial planning quiver, or it can be a total waste of time. The two fundamentals that set the table for the asset location discussion, the first one is that many investments, most investments, provide some sort of cash back to the investor as an annual return on investment. So stocks provide dividend yield, bonds usually pay income, mutual funds and ETFs can trigger yearly realized capital gains for their investors, even if the investor didn't actually sell off their shares of the mutual fund or ETF. That's just the way that those wrappers are taxed. So that's the first fact. Cash comes back to the investors. The second fact is that those dividends, the bond income, the realized gains, they're all subject to taxes, annual taxes, unless the assets are held in a qualified tax advantage account like a 401k or an IRA. So when they're held inside of a taxable investment account, then the investor suffers that annual taxation described before. So those two facts raise an interesting question. Can we intentionally place the quote-unquote high tax investments into our tax-sheltered, tax-advantaged accounts and then put the lower tax investments into our taxable accounts? And if we do this right, in theory at least, we should be able to lower our annual tax bill. We're not sacrificing any sort of investment returns or investment rewards. All we're doing is lowering our annual tax bill, leaving more assets inside of our portfolio to compound, creating some sort of positive long-term advantage. We're minimizing the so-called tax drag in order to maximize our total after-tax returns. This is the idea of asset location. Now, a discerning investor might ask, why not completely avoid investments that shed off too much taxable income in the first place? Like, wouldn't that just be an easier path? Why own any bond, right? If bonds are tax inefficient, which they are, why should we own a single bond in our portfolio? The short response, maybe the canned response, is that we don't want to let the tax tail wag the investing dog. So in other words, tax considerations shouldn't dictate investment decisions at the expense of sound investment strategy. Yes, minimizing taxes is important, but it really is a secondary goal behind risk tolerance, time horizon, diversification, and overall portfolio objectives. I can say from some experience that asset location isn't the only place where investors let the tax tail wag their investing dog. Some people avoid necessary portfolio rebalancing for fear of capital gains. They hold on to currently bad investments in order to defer some sort of capital gains. They stay overweight in their own company stock, in RSUs, in stock options, etc., to avoid taxes and capital gains. So a lot of times people permit the fear of taxes to cause them to do pretty dumb stuff inside of their portfolio. And ideally, that's something we don't want to do. Smart investors, yes, they optimize for taxes. It is important, but they don't let tax concerns override sound investing principles. The basics of asset location are pretty straightforward. So bonds tend to be tax inefficient, right? Bond returns come from annual interest, which cannot be deferred into future years. You can't defer the interest, and it's taxed usually at ordinary income tax rates. So if a bond has a 4% annual return, taxes, federal and state, can quickly reduce that to a 3% or lower after-tax return. I won't get into details here. Different types of bonds can be taxed differently at the federal or the state level, a municipal bond, a treasury bond, et cetera, et cetera. Stocks, though, are typically much more tax efficient. Though dividend yields can vary, it's common for a large diversified mutual fund or ETF, maybe like VTI, Vanguard's total stock market ETF, to have a dividend yield in the 1% to 2% range. Most of those dividends are taxed at capital gains rates, not at income tax rates. Capital gains rates are better. Asset location theory is pretty simple. If your portfolio needs bonds, keep them in a qualified account, shelter them from taxes, nullify the tax inefficiency of bonds, then fill up the rest of your accounts, including your taxable account, with stocks. If you're going to hold assets in a taxable account, if you've filled up all your qualified accounts and now your money has nowhere to go but taxable accounts, you might as well hold the more tax efficient assets in the taxable account. You can use the same thought process if you own other assets. Real estate investment trusts are famously extremely inefficient. High yield corporate bonds, very tax inefficient. Lower yield money market, cash, short-term bond funds are somewhat more on the efficient side. Again, it does depend on the interest rates for what it's worth. The big question is, well, does this actually work? Like, how beneficial is asset location over the long haul? And a really nice 2022 study from Vanguard clearly shows that asset location does provide a measurable benefit to investors. But the bigger question, which we'll answer in a couple minutes, is how and why particular investors receive much more benefit than others. And we'll also discuss when and why asset location strategies can go too far, becoming an actual detriment to other aspects of a financial plan. So for most investors, optimal asset location will yield an annual performance improvement of 0.1% to 0.2% per year when averaged over their portfolio timeline. So if you'd rather think in basis points, that's 10 basis points, right? 10 hundredths of 1%, 10 basis points to 20 basis points per year over the lifetime of their portfolio. A fair question, especially if you're the engineering type out there, is like, well, 10 or 20 basis points better compared to what? So the baseline in the Vanguard study was an equal allocation portfolio that assumed that all accounts, traditional, Roth, and taxable, had identical allocations. It was a 60-40 mix, 60% stocks, 40% bonds, in all three accounts. From that baseline, they compared various asset location strategies. So who does asset location help the most, and why does it help them the most? Well, there are really three main reasons why asset locations might help you. First off, more balanced and conservative investors see a larger benefit from asset location because their portfolios have significant bonds in them, and asset location works better with tax inefficient assets like bonds. The second cohort are people with higher income. They're in higher tax brackets. They see a larger benefit of asset location too. High earners have higher marginal tax rates, up to 37% on bond interest, up to 24% on capital gains when you include the NII tax. So a high earner simply has more taxes to save than a low earner, and it's just all the more reason for a high earner to consider asset location strategies. And last, people who will bequeath or leave to their heirs a more significant portion of their taxable accounts will see a larger benefit from asset location. So owning stocks in your taxable account is efficient, but it can become quite costly due to capital gains taxes if you need to sell those stocks. But if an investor plans to bequeath those stocks at their death, they'll achieve a step up in cost basis. They will avoid the entire capital gains tax that they otherwise would have owed if they sold their stocks during life. So, as I've written before, that's a little bit of a controversial aspect of current tax law. It's like a get-out-of-jail-free card for capital gains taxes. But nevertheless, if a large portion of one's assets will be bequeathed, asset location can become even more valuable. For those type of investors, they could see asset location yield an annual performance improvement of up to 0.3 or 0.4% per year, 30 or 40 basis points per year. But are there downsides? And the short answer is yes, there are some downsides to asset location if it's over-optimized. The first one is liquidity, accessibility, and timeline issues. One of the significant downsides of a perfectly optimized asset location strategy is that your accounts will assuredly no longer match the timelines in your financial plan. So for example, because of the time flexibility of a taxable brokerage account, I believe it should be generally more conservatively positioned than qualified accounts. So that means based on investing principles alone, a taxable account should probably have some more bonds in it than a qualified account. Similarly, most people view their Roth accounts as the last assets they'll ever touch. And when you look at a proper retirement withdrawal strategy, which I have a detailed, I think it's like a 4,000-word article all about the proper order of operations for retirement withdrawals. We can throw that link in the show notes. When you see a proper retirement withdrawal strategy, the rule of thumb usually is that Roth is last. And many people, in fact, see Roth accounts as kind of the crown jewel of their inheritance that they'll leave to their kids because they're not going to burden their kids with any sort of taxes if they leave them a Roth account. And so in many cases, Roth accounts have the longest timeline in someone's financial plan. Therefore, Roths should be the most aggressively positioned, all stocks. But asset location strategies typically conflict with those ideas. An asset location strategy would have no bonds in a taxable account. Instead, those bonds would reside in qualified accounts, including potentially a Roth account. Also, depending on an investor's age, an optimized asset location strategy can quickly be self-defeating, especially in turbulent markets. By sheltering bonds in a qualified account, we're also making them illiquid until retirement age, barring some special planning techniques that we've talked about earlier on this episode. So as such, a turbulent market could force us to sell stocks out of our taxable account at a time when we'd honestly rather not do that. Asset location strategies can also cause rebalancing problems, similar to the ones I just stated. An optimized asset location will likely lead to issues when rebalancing your portfolio because you can no longer rebalance within a single account. Every single time you rebalance, you're going to have to think about selling assets out of one account. And then if we need to, say, sell something out of our taxable account in order to fund our current lifestyle, well, asset location would probably dictate that that taxable account is chock full of stocks. So now we're selling stocks for a short-term need when we'd probably usually rather be selling bonds to fund a short-term need. And no, we're selling stocks. Well, that means that we have to go into a qualified account now and rebalance between an equivalent amount of bonds and stocks so that our overall asset allocation isn't really changing, even though the specific location of those assets is changing. The point is, it's just a little bit more complex than it needs to be, in my opinion. A few more potential issues with asset location: changes in tax law. Now, typically, I make tax planning decisions based on the knowledge we have today. I'm not in the game of predicting future tax law, but some people would argue with me, and the most common argument is that income taxes will almost assuredly increase in coming years. I mean, only time will tell. Changes in tax rates, though, capital gains treatment, new legislation could radically alter the effectiveness of an asset location strategy. It's happened before. It'll undoubtedly happen again. We just don't know when. I mean, what if the step up in basis upon death is written out of law? What if the capital gains bracket are dramatically increased, potentially even increased above income tax rates? Those type of changes would make today's, best laid asset location simply obsolete. There are other unforeseen externalities too. The things that come to mind is Medicare IRMA surcharges, how traditional tax deferred accounts often lead to higher taxable income, extra Social Security taxability and taxation, or just the phase out of certain types of deductions. The whole point is if you over-index on asset location, you might overlook other consequences within your financial plan. And then last, legacy and estate planning is a big part of overall financial planning. And it's always good to ask, well, what happens if and when I die? And as far as asset location is concerned, my main concerns are, well, what happens to your taxable investment accounts when you die? And what happens to your traditional investment accounts when you die? In general, as we've already talked about, your taxable accounts will be left to your heirs at a stepped up cost basis, nullifying any unrealized capital gains in those accounts. Your traditional accounts, if you leave them to a spouse, they essentially inherit them as is. But if you leave them to anyone else, kids, grandkids, something like that, they'll be converted into inherited IRAs for your beneficiaries, subject to specific withdrawal rules like the 10-year rule and the accompanying income taxes. Those different tax treatments really do matter. And optimizing for tax efficiency during your lifetime might not necessarily result in the best estate planning outcomes and the best tax outcomes for your heirs and for your beneficiaries. So I'm definitely a fan of asset location. After all, 10 basis points, 20 basis points, 30 basis points a year can really add up over an investing lifetime. That really can lead to some compound benefits. But I'm also a big proponent of maintaining proper investing principles, looking at the bigger picture. And I think if we focus too intently on just asset location, it'll cause more harmful side effects than positive main effects. Here's a quick ad, and then we'll get back to the show. Serious question. Why do podcasters constantly ask for ratings and reviews? Yes, they do help highlight our shows to new listeners. They help strangers find us on Apple Podcasts and Spotify. It's totally true and a good reason to ask for ratings and reviews. But I have something more important, at least more important to me. I want to know if you like this stuff. I want to know if you like my podcast episodes, my monologues, my guests, the information I share with you and the stories I tell. I want to improve and make your listening more enjoyable in the process. So yeah, I would love to read your reviews. And sure, if you throw a rating in there too, that's great. If you like what I'm doing, please share it with me. It's such a great feeling to read your feedback. I'd love to read your review or see a rating on Apple Podcasts or Spotify. Thank you. Two more quick topics. Well, one quick one that might take a few minutes. The quick one is Roth conversions. I talk about Roth conversions a lot. It's a pretty common topic to talk about. And I think because it's a common topic to talk about, some kind of maybe more casual DIY retirees, they hear it and they think to themselves, oh, I should be doing that. I've heard it talked about a lot. I should be doing it myself. Let me just go do it. And the way I respond to that is like, well, it only makes sense for certain people, right? Roth conversions are a tax arbitrage strategy. We hope to intentionally realize taxes this year because we believe, based on, projections of future cash flow, we believe that to not do that, we would suffer higher tax rates in a future year, paying lower tax rates this year to avoid higher tax rates in a future year. That's tax arbitrage, and that's the reason why we'd want to do Roth conversions. But sometimes I just hear people say like, no, I'm just doing it because I need more Roth dollars. Or like, no, I've just heard it's a good thing to do, and therefore I'm going to do it. And even if they are going to suffer a higher tax rate this year, instead of simply waiting for a future year when they might just be able to pull money out of a traditional IRA at a lower tax rate, no, they just want to do a Roth conversion and pay more tax for no reason. I even had a CPA come to me and we were talking about a client that I work with them on the wealth management side. He works with them on the tax side. And he was saying this person should do a Roth conversion. And we brought in our planning team just to kind of say like, well, why do you think that? And his rationale was, well, I'd rather her pay 24 cents on the dollar this year on a small amount and then let it grow rather than waiting 5 years or 10 years and paying 22 or 12 cents on the dollar. Those are the federal tax brackets in a future year. And it just doesn't make sense. If you understand the way that taxes, or especially, federal taxes and kind of Roth conversions and those kind of things, the way that they interact with federal tax brackets, all we need to do is look at marginal tax rates today and future, and that's it. There's this whole acorn and oak tree metaphor that I've gone into before on here on the podcast. The metaphor is a terrible metaphor. It doesn't make any sense. Would you rather shut off 20% of an acorn or 20% of an oak tree? The logic is that the acorn is smaller. People forget the fact that, well, if you shut off 20% of an acorn and then you plant it in the ground, the oak tree that grows up will end up being 20% smaller anyway because you're starting with 20% less money. The whole point is, probably belabored the point too much already, Roth conversions aren't an inherent good in and of themselves. They only make sense for specific people in specific scenarios if there's a tax arbitrage that they can take advantage of. The last punching bag today, which thankfully I don't see too much in the FI community, but if you spend time trying to learn about personal finance online, you will hear people talking about dividend investing as if it's this magic panacea. And instead, I want to make dividend investing a bit of today's punching bag. As we already talked about today, the fundamental value proposition of stock investing is twofold. We hope that a company's capital value increases. We want them to invent valuable intellectual property and buy land and build factories and earn more cash. And all of this growth comes from them investing money. They invest their own earnings wisely back into their own business so that we can then, as owners of stocks, of owners of the business, eventually sell our stock for a capital gain. And second, we hope that a company's earnings increase over time and that some of those earnings will flow back to us as part owners, as stock owners of the company. And those payments to shareholders, to stock owners, those payments are called dividends. The dividends we receive today, tomorrow, and every day in the future, they add up to the net present value of the company, or at least that's the way Warren Buffett would think about it. So both the capital value, capital gains, and dividends are a function of a company's earnings. So all investors' total returns are a function of earnings. This is a vital point, and we'll return to this point in a little bit. All investors' total returns are simply a function of a company's earnings. That's the vital point. So dividend investing is this kind of branch of stock investing where investors use a company's dividend payments as a primary factor as to whether they should buy the stock or not. And so by collecting a portfolio of high dividend paying stocks, these investors are ensuring that they will receive a strong dividend cash flow on a regular basis. And it's a fair question to ask. Well, aren't all stocks dividend stocks? I guess I don't understand the difference. If a stock gets money to me, the investor, through capital gains or dividends, well, what makes a stock truly a dividend stock? And well, yes, that's mostly true, not quite 100% true. So famously, Amazon's never paid a dividend. It's still a growing company. Growing companies rarely pay out dividends. Instead, they reinvest their earnings into their own company in pursuit of more further growth. So for that reason, Amazon would not be an attractive stock to a dividend investor, even though it's a terrific company that's provided great returns to its investors over the last 25 years. Berkshire Hathaway, Warren Buffett's company, has never paid a dividend either. Buffett strongly believes that for every dollar retained by Berkshire, at least $1 of market value should be created for the owners. And when Buffett reinvests $1 into his own company, they find really smart ways of turning that dollar into more than $1 of capital gains for the stock owners. But most companies will, at some point, pay a dividend. They'll have, limited internal opportunities for growth, and the best option at that point for shareholders is for the company to raise a dividend. And then the company will become a potential target for dividend investors. And my thesis against dividend investing is pretty simple. It's not that dividend investing is bad. It's just that it's overhyped. It's overhyped because too many internet gurus are sharing bad information, right? Remember, the term guru is popular because the word charlatan is hard to spell. Dividend investing promoters, they're just chock full of bad logic. So let me explain the purported benefits of dividend investing, and then I'll explain why those so-called benefits are simply misplaced. So the first piece of bad logic is people say, well, I get paid a dividend and I still own the stock. They're lauding a free lunch that they get from dividend payments. They're getting quarterly cash payment and they still own the underlying stock. I mean, what a deal. Well, first, as we've covered, this is really how all stocks work. It's not special. It's kind of like saying, well, my boss gave me a paycheck and I'm still employed. Okay, that's how jobs work. Welcome to planet Earth. So, dividend investors believe that their dividend payments are quote unquote something for nothing since they still own their full share of stock. It's just a false premise. So let's say I'm the CEO of Best Buy and the stock is trading at $100 per share and I choose to pay my investors a dividend of $2 per share. As soon as I pay that dividend, the stock price immediately drops to $98. My shareholders now have a $98 share plus $2 in cash. Why does the price drop? Because the market is smart enough to realize that my CEO wallet at Best Buy is now $2 lighter. Seriously, it really is that simple. $2 per share just disappeared off the company's balance sheet. And the market, of course they are, is smart enough to realize that fact. So now the stock price should be $2 less. The shareholders got their dividend at the cost of capital growth. Without the dividend, the stock price would still be $100. Remember, our vital point that we talked about just a couple minutes ago. All investors' total returns are a function of earnings. If you use earnings to pay a dividend, you will have fewer earnings to fund capital growth. The pie is finite and it's a function of earnings. Dividends do not create money out of thin air. You can't have your cake or your pie and eat it too. There is no free lunch. Now, the second piece of bad logic from dividend investors is when they say, well, I don't keep the dividend though, I reinvest it. Well, reinvesting your dividends is a terrific idea for any long-term investor. It's an essential gear in the compound interest engine, but it's not a special feature for dividend investing. Once again, the math explains why. In the example above, forgoing taxes for now, I won't talk about taxes for now, but just going back to the example above, if you took your $2 dividend from Best Buy and you reinvest it, you now go back to owning $100 worth of the company. It's just as if Best Buy didn't pay that dividend in the first place. It's the same math. But the dividend investor, they might say, well, but I own more shares now. I own my one share, and then I use my $2 to buy a fraction more share. And we'll get to that. We'll get to that point because I have an argument against that too. When a company does not pay a dividend, they reinvest their earnings on your behalf. Reinvesting your dividends is mathematically equivalent to the company retaining its own dividends and reinvesting them on your behalf. It's the same exact result for the investor, again, not counting taxes for now. And that's why the "but I reinvest" argument isn't really a differentiating argument for dividend investors. The third piece of bad logic is when a dividend investor says, well, dividend stocks produce a unique cash flow for me. As we've covered, dividends are a type of regular cash flow paid out to investors. But is that cash flow a unique feature that non-dividend stocks simply cannot replicate? And the answer is no, it's not unique. Once again, there's nothing special about dividend stocks here, because rather than accepting a $2 dividend from Best Buy, imagine a parallel universe where shareholders say, well, no, don't pay me the dividend, Best Buy. Keep the stock at $100 instead. And if I need cash, I'll just sell $2 worth of the stock. That investor could sell 2% of their shares. They would have $98 in Best Buy left over and $2 in cash. It's the same exact math. The only difference would be the taxation. Dividends and capital gains are mostly taxed the same. Depends on the type of dividend. But in the situations where they are taxed differently, dividend taxes are worse than capital gains taxes. It's yet another strike against dividend investing. Now, quick sidebar, someone might say, well, Jesse, in that example you just outlined, you're diluting your shares, right? Dividend investors would argue that my solution is bad because it dilutes my ownership. I had to sell 2% of my shares, whereas they, the dividend investors, don't have to sell any shares. And now, therefore, I must own less of the company. It's just another example, though, unfortunately, of mathematical semantics. There's a Google Sheet in this article. So this article will be in the show notes, and I have a link to a Google Sheet that you can go explore yourself that explains why. After 30 years where I show one quote unquote dividend investor and I show another person who's kind of following my just sell your shares point of view, the two investors end up in the same exact spot. A dividend investor will end up with more shares of a lower value stock plus a pile of dividend cash. And my suggestion results in fewer shares of a higher value stock plus an identical pile of capital gains cash. The final dollar values, the number of shares times the share price, are identical. It's kind of like saying what's more valuable, a $100 bill or 100 $1 bills. Dividend investors claim that they'd rather have the bigger pile of $1 bills. So just let that sink in. Bad logic number 4 is when a dividend investor says, well, wait, I own my dividend stocks inside of a tax-efficient account. Okay, well, owning dividend stocks in a tax-efficient account is a terrific thing. It really is. It's just as terrific as owning any other stocks inside of a tax-efficient account. This argument highlights the benefits of tax-efficient accounts. It doesn't highlight any special benefits of dividend stocks. The 5th piece of bad logic is when they say, well, I'll never sell, and that income will just keep on rolling in. This argument is that their dividends will continue forever, this just fountain of cash that never runs out. But companies are free to change their dividends at their own discretion, and they will do so when times are bad. Future dividends are anything but promised. Not to mention, we can choose to never sell our non-dividend stocks and create the same exact cash flow as I described in the 3rd example of bad logic. And then the 6th example here of bad logic is when they say, well, look how high the dividend is. It must be a great company. As I alluded to, there are some great companies, Amazon and Berkshire, that have 0 dividends. And there are some terrible companies that use their death rattle to raise huge dividends, begging some suckers to come in and invest in their shares. There's no correlation between the soundness of an investment and the presence or size of their dividend payments. So again, I'm not saying that dividend stocks are bad. I'm just saying that they're not special. And dividend investing as a practice is built upon the foundation that dividend stocks are special. If you build your philosophy on a false premise, you just get a bad philosophy. As I grew up in the country, and as my rural brethren would say, you plant corn, you get corn. I own hundreds of dividend stocks within my diversified portfolio. Index funds are chock full of dividend stocks, but neither I nor those index funds hold those stocks strictly because of the dividends. We hold them because the companies they represent will grow over the next few decades. It's that simple. Dividend stocks are fine, but there's no free lunch.
Thanks for tuning in to this episode of Personal Finance for Long-Term Investors. If you have a question for Jesse to answer on a future episode, send him an email over at his blog, The Best Interest. His email address is jesse@bestinterest.blog. Again, that's jesse@bestinterest.blog. Did you enjoy the show? Subscribe, rate, and review the podcast wherever you listen. This helps others find the show and invest in knowledge themselves. And we really appreciate it. We'll catch you on the next episode of Personal Finance for Long-Term Investors. Personal Finance for Long-Term Investors is a personal podcast meant for education and entertainment. It should not be taken as financial advice, and it's not prescriptive of your financial situation.